everyone. Welcome to the third quarter market and strategy update call. Couple housekeeping items out of the gate here. We, as always, have the chat and Q&A section in the bottom there, so please submit questions throughout. We will get to them at the end, and if we don't, we can always follow up with you directly. And as a reminder, this is for educational purposes only. It's not to be construed as investment advice. So now that we got that out of the way, maybe the other elephant in the room is that you'll see Mike Green is not with us today. I am filling in for Mike. So apologies in advance. I will do my best, but there will be a little bit less talk about passive, for better or for worse. I'm sure we'll be able to put in a little bit of that at some point. But I would like to introduce Jeff Schwarte, who is our Chief Equity Strategist. And I've invited him to join us today to talk about some of our new and exciting ways that we're solving problems for our clients in some of the legacy investment space known as structured notes. So we'll loop Jeff in, and he may also have some thoughts on some of the macro section that I'm going to outline up front. So thank you, everybody, for joining us. I will share my screen, and we will dive right in. Jeff, will you let me know when you can see my screen?
I will. Yep. All right. I can see it, Paisley.
You good? Okay, cool. Let's jump ahead then. So I might start by just saying kind of like what's going on out there. I think it's actually kind of funny, but this idea of there being a bubble, I think there's actually a bubble in the word, or using that terminology bubble. It seems like everybody's looking for a catalyst for markets to sell off or explode or implode, whichever way we're thinking about this. Drawing a lot of, corollaries back to the tech bubble. And I think a lot of us have already kind of mitigated some of that. There's strong fundamentals within a lot of these tech companies, but that's not to say that a set it and forget it type portfolio is the best approach here. So we'll talk about, some of the reasons why we think markets can continue to drive higher. But we do recognize that we're in a bit of an inflection point. I might view today's environment as really kind of coming up for air for the first time in 6 months. 6 months being kind of when that tariff tantrum occurred. And is the economy headed really for the dumpster, or are we on the verge of shooting higher? And there's a lot of catalysts that will propel us higher, including Fed rate cuts, strong fundamentals within the corporate sector. But ultimately, I think, irrespective of your clients or your personal objectives, there's just a lot of uncertainty. And the way that investors are thinking about how to solve for that looks very different across asset classes, risk tolerances. And Simplify is just really grateful to have the opportunity to have a stable of strategies and solutions across asset classes that we can help support your business and help your clients navigate this uncertainty. And we'll talk about some of those solutions as we get further in today's discussion. So would like to start by just kind of highlighting some of these key points you'll see on the slide and really exploring some of these macro forces that we believe are shaping today's investment landscape. The debasement trade, I know this is a term in addition to the word bubble. I think the word debasement is maybe the word of the quarter. But we'll talk about why we view that as more of like a long-term structural backdrop. And then, of course, what's really impacting markets, I would say, in the immediate near term is Fed policy. So we'll talk about the upcoming expectations for a rate cut and this increased liquidity and what that means in markets in spite of this inflationary concern and what that could do for the current bull market. I would also say, looking at some of those cautionary signals in the market, none of them are really flashing red, maybe a couple flashing yellow. But for the most part, market indicators continue to showcase we have more to run in the current environment. And then we would be remiss, of course, not to reflect on the fact that we've just hit this 3-year anniversary of the current bull market. And again, I think that's partly this momentum trade that we've seen, what's propelling a lot of clients to get cautious. But we have some pretty optimistic signals, I think, that would lead many of us to believe that we're just getting started. But it's not to say without hiccups along the way. So in summary, I would say, how do we then balance opportunity while staying vigilant or prudent for our clients? And I would say being diversified is the obvious way to do that. As Howard Marks said, there's no free lunch besides diversification in a portfolio. And then just remaining data-driven. So maybe jump right into some of this idea around this debasement trade. And we actually sent out an email, I believe earlier today, to several of our clients highlighting kind of our views on ways that we can provide solutions within this. But I think there's a lot of concern around the run up in gold prices. Obviously, central bank buying kind of what spurred the initial kind of tailwinds in this asset earlier this year. And then what we've seen in the last couple weeks and months is kind of the baton being handed to the retail traders. And I think that's what's causing a lot of this concern is this parabolic rise in gold prices over the last couple weeks and historic inflows to a lot of the gold ETFs in the marketplace. All of this, of course, underpinning this concern around debasement or loss of purchasing power within US assets. And so, again, this is not something that just started happening the last few weeks, albeit we're just now really hearing this in a lot of headlines. And it's something that aligns, I would say, with our mission and how we're providing unique solutions, how we're thinking about ways to diversify away from some of those traditional assets like bonds, perhaps that have seen a bit of an erosion of purchasing power or maybe have underperformed in the context of their key objectives in a portfolio to provide that ballast against equities. So some of this, of course, just due to rising deficits, continued inflationary pressures, and then even what we saw earlier this year with US assets underperforming kind of their global counterparts. So is this something that's here to stay? We'll, of course, have to see what transpires over the next couple months and quarters. But I do think that this theme is something that really has legs and ways to incorporate that within a portfolio context is moving beyond that traditional 60/40, thinking about hard assets, commodities, even crypto as a potential idea and ways to kind of untether from those, traditional assets like bonds within the portfolio. The other thing I might mention as well, then parlaying that into more what's in focus in the near term, of course, is rate cuts. I would say, in short, of course, anything could happen at the end of this month when it comes time for the Fed to cut rates. But with markets pricing a nearly 100% chance of a 25 basis point rate cut, it would take quite a lot for the Fed to deviate from that path. I do think at the end of the day, they want to ensure stability within the markets. And without the availability of data, given the government shutdown, I do think it's a bit of their hands being tied. And so I expect to see that come to fruition later this month. Ultimately, what that means is probably a continued bid to risk assets, and even potentially a bid to more of the small cap space. That's something that we saw in August of this year with the Fed kind of making mention of their September cut. So that could be kind of another catalyst for risk assets and equities broadly to continue to march higher in the fourth quarter, which seasonally speaking has been a very strong quarter for risk assets historically. The other thing I might mention too is as we look forward a couple quarters, Fed is expecting around 4 cuts in the next about 12 months, bringing us closer to about 3% Fed funds. If that is the case, and if if the curve normalizes, I do think that's healthy, of course, for the economy. But with that also being said, their expectations for some of the real growth versus nominal growth are still about 1.5 to 2%. So by no means recessionary type territory. So what does that mean from a market's perspective? There could be some volatility within the bond market, as we saw last year as well, if the markets start to reprice, just given more stable growth and continued upside in the equity market. It's kind of hard to continue to cut rates as equities hit all-time highs. So it's something that we'll definitely be keeping a close eye on. And then maybe just shifting gears into some of those cautionary signals I mentioned. Again, nothing flashing red at this juncture. High yield spreads continue to remain at historic tights. I do think it's interesting when we have these little blips and spread widening like we saw last Friday with the announcement of China tariffs, the impact that that then has on the high yield market, just given the kind of risk off environment and equities as well. But for the most part, we're still at historic tights. So definitely something that we're keeping an eye on. Simplify, of course, has high yield strategy in-house that has a way to alleviate some of the spread widening impact. But from that perspective, the volatility in fixed income markets as measured by the MOVE index, that also remains quite low post-tariff tantrum. And then, of course, we've seen a little uptick in the VIX in the last couple days here last week with some of the risk off last week. But for the most part, all quiet on the Western front, I would say, from a cautionary signal perspective. But one thing I did want to highlight, kind of a non-traditional kind of cautionary signal, and I had to find a way to somehow weave in the passive narrative in Mike's absence today. But Jim Bianco shared this interesting insight here. You'll see on the left-hand side of the slide. And I say this because over the last decade, I've spent a lot of time working with advisors in all capacities on asset allocation and portfolio construction. And many of them have their core passive large cap equities. And now they have this, NASDAQ 100 type exposure to give their clients more upside to AI and innovation. And if you really look underneath the hood, the NASDAQ 100 is a more concentrated version of the S&P 500. And you'll see that because the top 8 holdings in both of those indexes are the exact same with slightly different weights. And so I say this as another way to think about portfolio construction looking forward. And we've had such a tremendous run up within the equity market. How can we lock in some of those gains for our clients and start to diversify away from some of these rising concentration risks? And I just thought that was a really insightful proof point that I thought you guys might find helpful as well. So maybe with that being said, as we kind of close out this macro section, thinking about where we are in the cycle. So again, this month is the 3-year anniversary of the bull market, which started in October of 2022. And I like to put this in perspective and shout out to Carson Group and more specifically Ryan Dietrich on that team, who puts together amazing insights, really punchy charts and graphs, such as the one I'm sharing here. But if we look at the red line being the current bull market, and we've again just hit that 3-year track. So if we look at history, anytime we've had a bull market pass 2 years in duration, what kind of legs does that typically have? And so the average bull market that makes it past 2 years is 8 years in duration, which would tell us we're not even halfway there yet. The shortest bull market in history that has made it past 2 years has gone out to 5 years. So we'd still have potentially 2 years to run. And then the longest one is over a decade. So I just think this is helpful to be in a bull market through this kind of longer duration environment does not mean there's not going to be hiccups. We just had a 15-20% sell off earlier this year. We've already more than made that back. And so again, how do you help your clients stay on track through these bouts of volatility? And this goes back to the importance of diversification. So in all, I would say I view this bull market as being balanced right now, more so than speculative. But it is maturing. And again, there's ways to think about navigating the years ahead. So with that, maybe we will shift to kind of more of Simplify as a firm, some things we're excited about, some milestones that we've hit. We are now over 10.7 billion in assets under management, which we're very excited by. I just joined a year ago. And we've more than doubled in AUM. And I think that's super exciting to see the team and the expertise that we have in-house and some of the innovative strategies that we've brought to market to, again, help our clients solve some of these problems that we've just mentioned. 36 strategies, 3 of which are now over $1 billion in AUM. So we continue to build some of these flagship strategies that are category leading, that our clients are starting to notice. And again, AUM has picked up in many of these as well. So if we look at some of our highly ranked strategies per Morningstar, on the left, you'll see our high yield bond fund. I mentioned this briefly. AUM in this has now grown to over 400 million, which we're super excited by. And it's really a testament to the strategy's ability to navigate some of those spread widening environments that we've seen this year. Our managed future strategy, near and dear to my heart, but trend following is an asset class that has very much started to rise in popularity within a multi-asset portfolio because of the low correlations that it offers versus traditional stocks and bonds. And then I might also mention our pink ETF, healthcare. It is Breast Cancer Awareness Month, and all proceeds from the pink ETF go to the Susan G. Komen Foundation. And Jeff has done a lot of work with the team, which is an actively managed healthcare strategy. So I don't know if Jeff, if there's anything you wanted to mention on that.
Yeah, I think it's a great strategy. I think a lot of us know somebody that's been impacted by breast cancer, and it's great that sporting teams are wearing pink during the competitions. But yeah, I hit 4 years last week. As Paisley mentioned, she did a great job with the overview, but 100% of the proceeds, net profits, I should say, go to Susan G. Komen. They just had a gala last week in New York, and Simplify sponsored that, and it was great to participate in that. It's an exceptional long-only healthcare strategy, outperformed the benchmark, the MSCI MI US healthcare by 4.5% since inception. That's an annualized number, puts in the top decile relative to the peer group. And it's just a proof that investors can achieve strong results and lasting social impact. So, highly recommend Pink as a way to, kind of play this middle ground between like utilities and tech. Healthcare is a great solution for investors. And Mike Taylor is more than willing to and able to sit down and talk with any investors around. He's got a really cool pink blazer that he wears all the time. So feel free to reach out to us if you have more questions about Pink, but it's a phenomenal strategy.
Thanks, Jeff. I might also mention, just because you mentioned that event for Pink, Simplify held its annual conference at the New York Stock Exchange in late September. And we now have all of the individual sessions that we held at that event available on our website and also on YouTube. So if you missed that and you weren't able to join live, all of those are recorded. So definitely go check that out because we had some really fascinating discussions across asset classes and across macro themes. Um, the other thing I might mention too, before we start to get into some of the specifics, is on some of these funds, and really giving Jeff the mic here in a minute, is some new strategy launches. So again, we continue to find ways to help solve problems for our clients. And I think one of those ways has been in the private credit strategy that we launched towards the end of September. This is an indirect play on the private credit market. To be very clear, it is an ETF, it is daily liquid, it is fully transparent, and it is investing in BDCs as well as closed-end funds of the underlying companies within the private credit sphere. So this is a great tool for clients that are maybe using this as like a holding reserve as they're ramping up or getting capital calls within their direct private credit space. It can also be viewed as a proxy for those maybe kind of smaller clients that don't have access to the actual private market space. But we launched that with our partner Vetify, which we're very excited by. And then also the launch of our government money market ETF. It is subject to the 2A7 rules, so it is considered a money market fund and is one of more cost-effective solutions in the ETF wrapper for those looking to incorporate, especially within the model portfolio business, which continues to grow. All ETF models, I would say, are rising in popularity. And so many of these money market funds legacy have been a more the mutual fund wrapper. So this was our solution to help our clients allocate within the cash sleeve of some of these multi-asset portfolios. So today's funds in focus, we'll spend a lot of time talking about our barrier income ETF. The ticker on that is SBAR. And as mentioned, Jeff is the chief strategist on that. Also want to talk about some of the fixed income strategies. I think oftentimes Simplify is viewed as the alternative provider in the marketplace. And we just like to remind our clients that we are all things alternative, meaning alternative solutions within your core fixed income, alternative solutions within equities, as well as those traditional portfolio diversifiers like liquid alts. And we've had some strong performance in some of those core fixed income strategies, so wanted to highlight that over the last quarter. And then lastly, we would be remiss not to mention our gold ETF and managed futures, which continues to deliver on its diversification objective. So without further ado, and because everybody's probably sick of hearing my voice, I'm going to hand it over to Jeff to talk about our barrier income ETF.
Thank you, Paisley. Hey, maybe just a quick comment about the market. We're kind of in an interesting, the stock markets more specifically, we're kind of in an interesting environment where we have multiples expanding as well as earnings revisions happening, in areas that people are probably under allocated, small cap, international, maybe some EM. And it's a very interesting time as we're transitioning to more, I feel like there's a bit of a layering of risk into portfolios. We've all enjoyed the returns from the Magnificent Seven stocks, the S&P, NASDAQ. As Paisley's pointed out, there's tremendous concentration risk within those particular names, but they also have significant earnings growth. So it's a pretty good space to be in. So I think investors, as you're trying to position, I think it's prudent to start layering, some small cap and international and other parts of the market that maybe even under allocated to over the last 3 to 5 years as they've underperformed. I do think that a broadening of earnings growth is happening in the market, and with rates cutting, I think that can continue. By way of introducing SBAR, so we've interacted with a lot of clients that have expressed interest in a more of an income-oriented solution. So as we're showing on this particular slide here, SBAR since launch in mid-April, has realized annualized um, distribution yield of about 12.9%. And one of the things that we're constantly hearing from investors is the need for income. With 10,000 baby boomers retiring every day, they want that paycheck, and so they're looking for derivative income-oriented solutions to provide that. Whether you're selling calls, whether you're doing, our asphalt product, which does short VIX, they're looking for that income stream. They want that monthly paycheck. But they're also worried about the markets. We're at all-time highs. We've enjoyed tremendous returns, as Paisley mentioned, a 3-year bull market in equities. I think a lot of investors are quick to want to liquidate and take profits and recycle that into income solutions. And so that's why we developed SBAR as a way to get really two of the features that Simplify brings to the table, that income orientation as well as a protection level. It's a 30% barrier for SBAR. So what that really means is when we sell a barrier option at the end of the time period, if the underlying indices break the barrier, then the fund participates in that drawdown. If markets are down, the reference indices are down 29%, there is no participation in the drawdown. And we use 3 different equity indices. We'll get into more detail in a moment. And then really when you start thinking about this, when we get money into the portfolio, we're buying treasuries, we're selling a barrier option. We're not going to have credit risk because we're not buying bonds other than treasuries. And we don't have counterparty risk because we've sold something to an investment bank. So we already have the capital and limited duration risk just because of the treasuries. So we like to think of it as it's an alternative to equities. It's an alternative to bonds. It's a unique source of income. I use the insurance analogy where you're selling auto insurance. In the event there's a crash, if Paisley crashes her car tomorrow, the insurance company will pay that claim. If she doesn't, the insurance company keeps that. We're doing the same thing. We're underwriting equity risk using a product called barrier options. And we'll talk a little bit more about those in a moment. And then I also want to highlight that this is a completely liquid ETF. So unlike some other wrappers like annuities or other funds that have a queue to get in or a queue to get out, this is completely liquid like any other ETF in the marketplace, fully transparent. We publish the positions every day on our website. And so to me, double-digit income, a new source of income, and you got a barrier of protection, if you will, and then completely liquid is really the exciting part about SBAR for investors that want to maybe take profits in equities and look at this is a source of that capital. So SBAR, in our opinion, checks all 3 boxes. Next slide, please, pleasing. So real quick, just big picture, we're going to give you income. We have a downside feature and diversification. So the income is not coming from stocks or bonds. It's coming from selling a barrier option. So we come across a lot of advisors that have used structured notes. Essentially, that's what SBAR is. It's a structured note with auto callability. I'll walk through that here in a moment. But on the top right-hand side of the slide, this is the feedback we've gotten from advisors using structured notes is they're inefficient, they're expensive. It's a negotiation between individual brokers and the advisor. You have to constantly monitor for call features. Just operationally kind of difficult. We've come across a couple bigger advisors where they have teams of people that just monitor their structured notes. And so SBAR takes advantage of that and helps advisors not worry about those operational efficiencies. We're taking care of that for them. On the left-hand side, what you gain by the exposures you gain by SBAR is that annualized distribution yield. We would expect over a full market cycle that number to be between 9 and 11%. It's higher than normal because we are in an elevated vol environment. So the option premium we're generating from selling options is pretty attractive right now. And so that's benefiting investors by having that higher than we would expect distribution yield. Again, you only participate in the drawdown if the underlying indices, which there's 3 of them, S&P 500, NASDAQ, and Russell 2000. At the end of the 1-year time period, we're looking to see if those reference indices, if any one of them went through the barrier of 30%, then you participate in the drawdown. If you're down less than that, there's no drawdown risk. And that's a way we're enhancing the yield as we're doing worst of. That's looking at 3 different equity indices. You look at the worst performing over the tenor, which is 1 year. And then the other feature that's super cool and interesting, it's an auto call feature. We are the first ETF issuer to launch an auto call ETF. So the way that works is if we sell an option that January 1st, if all 3 equity indices are above the initial value, that gets called. It's contractual. It gets called. the amount of premium we get is an annualized premium. So we are able to stack that premium onto other renewals of that barrier option position. So callability and worst of are ways we're enhancing it, and we're getting the exposure for investors through swaps to make it operationally efficient for us to monitor these positions on your behalf. Again, transparent, liquid, distributions aren't paid monthly. So been very, very well received by investors. The ones that are using structured notes like the operational efficiencies. Those that haven't looked at structured notes are now giving it a fresh look because their compliance departments or the complexities of them, the negotiating ability, they really don't want to get involved in that. They don't want to bid out of infrastructure. So two audiences, existing structured note units like it because of the operational efficiencies. People that haven't used it, that are comfortable with ETFs, are liking the outcomes with that juicy distribution yield.
And I might just mention as well, from a use case perspective, beyond what you just mentioned, is that we're seeing widely kind of adopted use of this within income models. So as rates
Mhm.
start to come down with the Fed starting to cut, cash rates are coming down, which then impacts a lot of the other strategies in the fixed income sphere. So if you have clients that have target income needs of 7, 8, 9, 10%, let's just say, it's going to become, and it has already, increasingly difficult to meet those spending needs if rates start to drift lower. And so this
Mhm.
can be used as a bolt-on as well within a more diversified income model to help achieve some of those higher target distribution needs.
Yeah, that maybe I'll drill down a little bit more, Barry, on that one, Paisley. As rates normalize on the front end of the curve, we would expect the yield to come down a little bit with SBAR, but the barrier option premium is going to be a function of the volatility. So if we're in a volatile upward trending market, that's probably the best case scenario for SBAR, where you have volatility, so you're getting a juicier option premium. An upward trending market means we have the call feature that will kick in, and we can stack calls of these barrier options. Just by way of a little bit of a portfolio construction perspective, we don't have a single bearer option in the portfolio. We ladder that over. As of Monday, we had 34 bearer options with varying maturity dates. So that helps manage path dependency risk. And then we will, at times, we do it right now, we do have a protection mechanism within the portfolio. We're long a put option with an expiration at the end of the year. In the event something does go horribly wrong in the market, which we're not forecasting, if it does, we do have that ability to buy a put option to protect the entire portfolio. So again, this is active management 101. We're doing an exceptional job finding unique sources of income. I think the idea of getting double-digit yields with a corridor of protection of 30% is pretty attractive. With continuous liquidity, yields on SBAR are significantly higher than some of the other competitor products that you see in private credit and annuities, for example. This is just a visual. This is like an outcome of a single barrier. Essentially, what's happening is we're gonna buy treasuries with the capital that comes into the portfolio, and we're gonna sell a barrier option. That money gets distributed on a monthly basis. Typically, it's the last couple days of the month, pays out the first of the month. So no matter what happens, you're going to get that income stream. And then that's your income piece of the total return. The NAV is driven by what happens to the reference indices. So we look at the three indices, NASDAQ, Russell, 2000, and S&P 500. If any one of those, the worst performing of those, if it breaks the barrier, then the fund with that one single position would participate. Now, if you go back, look at the last 35 years on a weekly, rolling 1 year weekly resets over the last 35 years, you broke the 30% barrier just 10% of the time. So a 90% probability that Paisley doesn't crash her car. We get to keep that premium and distribute it to our investors. In the event she does have a difficult time driving, we pay the claim. Same thing here. If the markets do have an event where you're breaking the barrier, we have to pay that capital to the counterparty. But that's the risk you take, and that's the income that you generate as those premiums of selling those insurance policies.
I'd like to report in my own history, there's been 0% of times when I've crashed my car. So
All right, keep it up.
I'm offended, Jeff. I don't want to be that example.
No worries, no worries. I think I have one more slide. Okay, so here's an example of what we put on our website every single week. This shows the 34 positions, and this is on the y-axis of the top right-hand chart. We're showing the amount of drawdown the market would have to experience for a single position to break the barrier. So the one on the furthest left, you look at the line represents NASDAQ, S&P, and Russell. What really matters is the bottom of the line. So right now, that first position, 10.1%, which is the x-axis, it has to go down over 35% for that one to break the barrier. Keep in
So
mind that
Jeff,
one.
just to clarify,
Yep,
because the first time I saw this, it took me a minute.
sure,
The x-axis here is the position size of
correct,
each of these barrier options. The dispersion between the top of the line and the bottom is because, again, we have the worst of. So there's
correct,
diversification. This is
correct.
likely often at times the Russell 2000 at the bottom and NASDAQ at the top, at least for the last, 12 months,
You
let's just
you
say.
got it.
But
Yep.
that's exactly, the numbers in the bottom threw me at first, but that's a position size. And then again, this is like really focusing on the bottom of each of these lines to determine where we are from a barrier perspective.
Correct. Now, if that number is the higher the number, the higher probability it becomes called when you achieve that non-call period. But you're exactly right, Paisley. So the first line it represents 10.1% of the portfolio. It would have to go down just under 35% for that single position to break the barrier and you participate in the drawdown. As you can see by this, the average distance to the barrier is 30.5. So in order for the entire portfolio to participate in a drawdown, i.e. a claim, i.e. Paisley crashing, market has to go down over 31%, which again is very, very rare. Um, right now, two-thirds of the fund is eligible to be auto-called, which is that super cool feature of stacking yield premium. Distribution rate of 12.8, and then SEC yield of 4. That's really the treasury yield. SEC yield does not include derivative income. Right-hand side, typical position is going to be 1 year. We're going to ladder the non-call periods between 1 and 3 months. The vast majority of them are 3-month non-call features. Uh, Always, 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 every barrier option will be 30%. The distribution target will vary given volatility, given premium in the option market, given treasuries. And an SBAR will always do worst of indices, NASDAQ, S&P, and Russell. On our website every Sunday night, this gets published. Um, it gives investors visibility into the distance to the barrier. And as you look at this right now, we have a long ways to break the barrier. So stuff would really have to get difficult on a go-forward basis for the fund to have a significant drawdown. Now, having said that, I also want to remind investors that if we get in a market where the market's down 10, 15%, these positions do get marked to market. So it's not like you have zero unrealized gain loss potential. The positions will get marked to market just like every other publicly traded 40s Act fund. So you could experience an unrealized loss as markets drift lower, but knowing that you're not going to participate fully if you stay above the barrier of 30%. I just want to make sure investors
Yeah, great
understand
point.
that there will be mark to market throughout the experience with investors.
Great point. And then I would also, I know we've given a lot of details here today, but Jeff and our lead portfolio manager on this, Sid, have recorded some fun deep dives that you can find on our website. A lot more materials also on the website landing page, including that weekly update that for the visual that you are seeing on screen right now. So really what we're providing is a very transparent, liquid way to innovate on what this historical, structured note space has provided for clients. We know that's a big part of a lot of advisors' book and the way that they help their clients meet their income objectives. And so we really sought to bring kind of a more modern approach to market through the barrier income. And then one strategy that we haven't mentioned, similar in nature, but rather than that 30% barrier, it has a fluctuating barrier with a target distribution, and that is a 15%. So that's the target 15 strategy. The ticker on that is XV. And so you'll also find information for that on our website. But really, this SBAR strategy with the 30% barrier has resonated with a lot of clients and really fits that sweet spot of needing extra income in a more prudent approach. Anything else, Jeff, that you want to mention before we scoot along?
No, I think that the key selling points are high double-digit income. You've got this corridor protection, unique source of income, and then it's liquid. I can't stress that enough. The ability to access the capital when you need it. You can enjoy the income until you need it, and you can liquidate it. To me, is a huge selling point versus some of the other products investors can buy in the market.
Awesome. Well, I know we are very proud of this launch. And as mentioned, we've seen quite a bit of interest and adoption. And so these strategies are continuing to grow. So please do reach out if you guys have questions. We'd love to get you on the phone with Jeff or Sid to talk about how this can fit within your portfolio. So let's pivot. Let's talk a little bit about some of our fixed income strategies. When we met last quarter, We had really just come off of a really rocky quarter. Second quarter was rough for a lot of markets, a lot of volatility induced in both equities and bonds and even diversifiers. So fast forward, everything feels pretty good right now, but we like to reflect back on what that means then for our strategies that are selling volatility or that are harvesting some of the volatility that we've seen in the marketplace. And so what you'll see here on the far right is a measure of bond volatility as defined by the MOVE index. And really what you see that massive spike is in the midst of April and that tariff tantrum. And we've been on a kind of a one-way street down from a volatility perspective in bond markets, which makes sense. Bonds have actually been doing quite well. They've really continued on this pace of expectations of rate cuts, and there's been no hiccups along the way. And so what does that mean then for our portfolios? And we'll mention two of them here in a moment. But our treasury option strategy and our core bond strategy, which saw a lot of volatility in April, given where they're selling treasury options and some of the strategies themselves. So coming out of these environments, like any strategy that's selling volatility, the premiums that you are then able to earn in the post-vol environment, and this actually goes for SBAR as well. We launched that at a very opportune time in April, right after the market shock. And so that's why SBAR, even though longer term might have a slightly lower distribution rate than we've been able to achieve thus far, we've been able to clip some really attractive income through those barrier options. And so that kind of transcends into the fixed income market as well. And so the option premiums that we've been able to receive in these strategies in that post-vol environment have been quite attractive, and it's really led to some strong performance in both of these strategies, Buck and Ag H, that we'll speak about now. And just as a reminder, Buck is our treasury option income strategy. We view this as an alternative to just holding cash. It's a yield enhanced way to think about having more fixed income exposure within the portfolio with limited credit risk, because again, we're just investing in treasury bills and writing options on longer duration treasury futures. So the target objective of this is 1 to 2% over treasury bills. And what you'll see on the right-hand side is for the third quarter in particular, the white line is Buck. It's the NAV of Buck relative to the orange line, which is just T-bills. And you can see here again, this post-fall environment as vol settled. A lot of those options and the premium that we're able to achieve is quite attractive, which boosted returns over the quarter. And so this strategy has performed exceptionally well over the last 3 months and has continued to deliver, especially within our income portfolios or those model portfolios that I mentioned prior. This has become a core part of many of those with a current annualized distribution rate in excess of 7%. So you're getting high yield type distribution rates from a strategy with limited credit risk, which we find very attractive as well as our clients do too. So if we move out the curve from a duration perspective a little bit and start to think about more of that core bond space, Ag H, which is our response to active core bonds, but rather than through credit selection or duration management, we're really viewing this as a structural alpha. So our lead PM on this is Shailesh Gupta, who came over from PIMCO and is kind of writing from the same playbook that the Total Return Fund has done historically over at PIMCO, and looking again at that structural alpha through option writing programs. And so how can we provide higher distribution rate than the core bond market and do so in a way that's diversified? I think that's very important as you're thinking about core bonds for those that still have belief within bonds. How can you think about diversifying some of those risks? And many clients and investors, typically just benchmark that to kind of the core passive space, and they'll have some active management surrounding that. But typically all those active managers are kind of singing from the same songbook, which is more of a fundamental approach. And so this is more of a rules-based structural approach to thinking about active risk within core bonds. And you'll see here on the far right, the white line is Ag H, the NAV price over the third quarter relative to the orange line, which is the Bloomberg US Aggregate Bond Index. And you can see this kind of steady structural alpha that Ag H has been able to deliver in an environment where bond volatility has fallen meaningfully. And so the strategy is really ripe to continue to outperform in some of those kind of structural premium that Shailesh is able to capture in the strategy. So excited to see that. And again, as a reminder, just a way to think about diversifying within some of your core bond exposure. The last strategy that I'll mention within our fixed income stable is our high yield strategy, CDX. Lead portfolio manager on this, Mike Green. Um, and again, I think this has been the growth of the strategy has been a real testament to this embedded hedge that we have on. Within CDX, we have an overlay, which has a quality minus junk approach within US equities, actually, that really co-moves with spread widening. And so we're meant to cushion when high yield spreads widen and the price of high yield bonds falls. And that's exactly what this has delivered. We launched in 2022, so we now have about a 3.5 year track record. We have, like I said, just north of 400 million in AUM and category leading results, especially for the year to date period. Um, and the way that we've done this is through this proprietary hedge. And so the first quarter, we really saw this come to life and the importance, especially in an asset class that can be subject to defaults and a lot of volatility. The yields that you get by moving from core bonds out to high yield are really attractive until they're not realized. And so the impetus of this is how can we protect your high yield exposure to make it all weather? We know that many of our clients and investors prefer a tactical approach to high yield, meaning when spreads blow out to 4, 5, 600 basis points over treasuries, they'll then invest in the high yield asset class. As spreads come below 300, they'll exit the asset class. For many of them, that has worked, but we know that requires a lot of active effort on the behalf of these investment teams. And ultimately, you have to get two calls right. When do you get in and when do you get out? And so if we can build this more strategic all-weather solution to high yield, it allows our clients to focus on other parts of the portfolio while still outperforming core high yield, which is what we've done since inception. Year to date, we're up over 2% or 200 basis points over the high yield benchmark that we're tethered to, and just really kind of looking at how spreads have moved and some of these like short-term volatility shocks. The importance of having a more prudent hedged approach to your high yield, we think, is paramount. So really excited to see this fund grow and excited for our clients to see the importance of having a more prudent approach within asset classes that can be a little bit more beta or more risk on in the market. So to wrap up for today's discussion, we'll talk about more of our liquid alternative space. Maybe a quick shout out for CTA. We've started publishing for the last 3 or 4 months now a monthly update where myself and Charlie Magera, the CIO of Altus Partners, who's our futures advisor on this strategy, he and I do a 10-15 minute video recording. You can find that on our website and on our YouTube to give our clients and investors insight into positioning, performance, and the market backdrop at large. We know that sometimes this part of the market can be considered a black box. That's exactly what we don't want our investors to think. So we try to provide as much transparency into how the fund is behaving and performing as such. So please check out those videos. But I would say in whole, third quarter was really interesting. We had some volatility spikes in the trend following space with some of the interest rate positioning. So you'll see that in the white line. But all in all, after what was a very rocky second quarter for trend following, third quarter proved to kind of get its act back together across various strategies, and trend following and CTA was no exception to that. So strong performance in the third quarter. But I think more importantly, from a bigger picture perspective, annualized since inception performance on this strategy has been equity-like in nature. We've been in excess through at least quarter end of 9.25%. I think through October now, that's even in excess of 10% annualized return on a strategy that has negative correlation to the S&P 500. So if you're thinking about ways to adopt diversifiers within your portfolio and you don't know where to start, we believe that trend following and CTA in particular checks all of those boxes of how can I actually get an uncorrelated source of return in my portfolio without sacrificing returns. And then put another way, we consider this a hedge that you get paid to own. So CTA continues to deliver, and it's now north of 1.2 billion in AUM, which continues to be category leading. So super excited and proud of the strategy performance that this has delivered. So I figured we maybe just end on the topic that we kind of started on, which is gold. So Simplify, from a timing perspective, I think nailed it again. We talked about how SBAR and XV launched right after the vol environment in second quarter, which was very advantageous for performance. We happened to also launch our gold strategy last December. So we're just shy of a year on performance, but we've seen a lot of adoption as the strategy has significantly outperformed many of its gold ETF peers in the marketplace. And the reason for this is twofold. First is that we take a levered approach to gold. So we have, rather than 100% notional exposure, we're accessing gold via futures and we're putting on 1.5 times exposure. So if you are a gold bug and you're really looking for gold exposure, this is going to be a more capital efficient way for you to allocate to gold within your portfolio and perhaps not have to allocate as much. So that was our intention of being capital efficient. And then in addition to that, a common pitfall or reason why investors poke holes at gold is that it doesn't give you any income. So we talk about real assets providing maybe better purchasing power over time, but oftentimes clients will say, yeah, but my clients need income. And so we put our proprietary income overlay on top of the exposure, the levered exposure of gold in this strategy. So you're getting additional exposure to gold in a capital efficient way, plus an option overlay, which is providing income to alleviate that common pitfall of gold. So these numbers are kind of crazy to share, just given the rise and parabolic rise in gold that we've seen broadly in the marketplace. And again, remembering that this is 1.5 times exposure to gold since last December, why gold is up almost 70%, which has outperformed broader gold or our benchmark by about 22% since inception, and significantly outperformed bonds over this time as well. It's been about 64% excess return versus aggregate core US bonds. And the distribution rate on this has fluctuated currently as of September month end is 9.9% annualized distribution yield. So again, alleviating that common concern, giving our clients capital efficient exposure to an area of the market that just seems to continue to rise in popularity within a portfolio. So with that, that is all of the prepared remarks that we have. Jeff, anything I forgot to mention or anything that we'd like to revisit?
No, no, I'm glad you mentioned XV, which is Roman numeral 15. It gives investors a target yield, which means we change the barrier to achieve that target. So thank you for mentioning that, Paisley. No, I think lots of good information here to process. And as always, we're here if you have any questions.
And I can't see the Q&A, so let's see, I can stop sharing my screen. Questions. Anything, Brian, that we didn't address one-on-one that we'd like to discuss?
So there's some questions in here on SBAR, asking about Jeff.
Mhm.
How would you think about duration in SBAR? And if you could just kind of run through how the barrier 30 works real quickly again,
Sure.
that'd be appreciated.
Yeah, from an actual duration calculation perspective, we're going to own the treasuries typically three to 6 months or a year. So whatever duration calc you come up with there, it's going to be fairly low. And then the term structure of each of the bearer options is 1 year. And there's going to have a non-call feature of 1 to 3 months. Most of the positions are 3 months. So, which means it's not eligible to be called unless we anniversary the 90-day window. And as a reminder, it only gets called if all three reference indices are above the initial value. So that's the answer there. I don't think you can put a traditional duration calculation on it since the drivers of the income are going to be equities and the drivers of the NAV are going to be equity returns.
And then what do the premiums look like? How do those
Mhm.
fluctuate over time for our counterparties there? How do they
Yeah,
calculate?
so upon launch, which was mid-April, if you all remember, April was kind of a crazy month, especially April 9th. We were generating per position around 3.2% annualized yield. We just did a contract this morning at 4.2. So they're going to move between 3.25 and 4.25. Again, that's an annualized premium. If it gets called, you can stack that with other premiums that you've generated. So that number will obviously change given the vol environment. If the vol environment becomes Goldilocks, where equities are very stable, bonds are very stable, that premium would likely drop a bit. But as Paisley's pointed out, there's a lot of headlines and news items that keep vols elevated, which I think creates the opportunity to get higher yields.
And that's it.
Great. I might just close us out then by reiterating how grateful we are to all of our clients and our partners in the industry. We couldn't do this without you guys. We're always accessible and available. We have a deep bench of individuals here. Jeff Schwarte is just one of them with broad expertise, and we're always eager to get on the phone and talk about how we can provide solutions, how we can continue to innovate and support your business. So thank you guys for your support and your trust and Simplify, and we will see you guys next quarter, if not before then. Appreciate your time.
Have a good night.